Welcome to our Capital Market Outlook. What is our investment strategy for the 12 months ahead? At the end of 2023, we presented you with our positive outlook for the investment year 2024. We expected a bumpy first half and a recovery in the second half. We were right about the positive outlook. However, the first half of the year went better than expected for stocks and worse for bonds. This was partly due to the fact that America's economy didn't falter as much as feared, and partly due to the accelerating investment boom in AI technology. So what does this mean for our outlook for the next 12 months? Let's start with the economic basis, which we would call normalization. We expect global economic growth of around 3% in 2024 and in 2025. We expect that the US will initially weaken somewhat before growth picks up again in 2025. And Beijing's government is doing everything it can to push China to 5% growth this year. In 2025, we expect 4.4%. What can we expect from central banks? Some major central banks have already started their interest rate cut cycle, but the US Fed is still waiting. We expect it and the ECB to make 3 interest rate cuts over the next 12 months. This is made possible by declining inflation rates. For the US and Europe, we expect rates below 3% by the end of the year. However, wage developments, especially in Europe, must also play along for this. What does this mean for bonds in particular? This means 2 things for the bond markets. Firstly, things should now be better for government bonds. At the longer end, we do not expect any further yield increases and therefore no price declines. However, for shorter-term bonds, yields should fall as a result of the key interest rate cuts and prices should rise accordingly. Risk-adjusted, we therefore like shorter-term US Treasuries best. Corporate bonds still have attractive high absolute yields. However, we see little price potential from a further decline of risk spreads to government bonds. They are already at historically low levels. We particularly like Europe's investment-grade corporate bonds. In some emerging markets, we believe that high-yield bonds in particular should benefit from the interest rate cut cycle in the US. Can equities continue their solid run? A stabilization of bond yields at the longer end also helps equities. They are further supported by rising profits. In the US, these came primarily from the technology sector and in Europe from the broad cyclical recovery. In our core scenario, we assume that these trends will continue. This could result in return potential in the almost double-digit percentage range, even if the 8 months long stock rally has already raised valuations considerably. We are continuing to focus on Europe, where the time for small caps could slowly be dawning. And in the US, on the still affordable AI-related segments in the technology and telecommunications sector. However, we also like Asia for both cyclical and diversification reasons. The fact that only a few stocks have driven the stock market so strongly this year is just one of the risks that should be kept on one's radar. The declining consumer sentiment in the US, the ongoing trade dispute with China, the persistently high US budget deficits, and, of course, the war in Ukraine continue to make a diversified portfolio advisable.